Welcome back to segment 4.2, Navigating the Funding Universe. Today we're going to talk about different types of funding. We're talking about the stages of funding, the types of financing, different kinds of investors, and sales or exits of your business. Let's talk about the stages of financing for your venture. We've previously discussed the timeline of your investment and how much money you will need. That was in the last segment. Now we're going to look at this graphic, which was from the last time, and we're going to see when different types of financing are most appropriate. What we covered last time was the seed financing versus the expansion financing, but that can be further subdivided. So on this graph, you'll see more or less seed financing, and seed financing might be divided into different categories, and then there could be different rounds of financing over time. So usually we consider the first round of financing where equity is given up, where partial ownership. We're going to talk about that more in a few minutes. We call that the Series A financing. And then as expansion financing kicks in, we would collect more rounds, we'd have more rounds of financing, and we would call that the B round or the C round. So every time we have more financing, we have an additional letter of the alphabet. Now, in some cases, the early stage seed funding is often called seed funding or early stage funding, but it's also sometimes called AA, Series AA. Usually, AA refers to the round where there is no equity given in the company. So there's no ownership or control of the company given out, but there's some money raised. Now let's discuss different types of financing. We're going to talk about 4 different types of financing today. There are actually many more kinds, but these are the main 4 that you'll probably hear about and that you'll probably use. The first one is a gift or donation, and that means that you are receiving some money with no expectation that you're going to give the money back. Then we have debt financing, where there is an expectation that you're going to give the money back, possibly with an interest payment, so you give them more back than what you borrowed from the investors. And then we have equity financing, which is basically an ownership share of the company. And then finally, we're having convertible debt, which starts out as a loan and then possibly converts to an equity position in the company. So let's go through each of these one at a time and talk about the pluses and minuses of these different options. The first one is gifts or donations. And these are cash or in-kind contributions that someone provides to the entrepreneur. They are given with no expectation of getting anything in return. So it's really free money, if you think about it. Now, why would you want to have a gift or a donation? It's clear that there's no strings attached to this. There's no consideration. Consideration is when one party gives up something to another party in exchange. So in this case, you're really just getting the money. Now, the disadvantage of this approach is that it takes time to raise gifts. We mentioned before in one of the prior segments, this raising money is not free. It takes time. It costs you something. And in this case, you're going to raise a lot of gifts. They can often be quite small, and you might end up spending a lot of time to raise this sort of money because it's hard to attract people to give you gifts unless you know them very, very well. The second type of financing that we want to talk about today is debt financing. Now, debt financing is when the entrepreneur promises to pay back the money with interest. This is a loan. It's called a loan, and it occurs for a certain amount of money. So I'm borrowing $10,000. I need to pay back the $10,000. The loan itself is often called a note or a bond. Bonds usually not used with startup companies, but a note refers to the loan instrument itself. In many cases with startup companies, the debt is not collateralized. In other words, it's an unsecured loan. They're lending you the money and you don't have any assets to sell off in case you don't pay them back. So therefore, the borrower has to pay interest, and the interest is pre-decided. Of course, some lenders, like your family members, may give you a loan with no interest. They want to get their principal back. But most investors will want to receive interest. It's also called the coupon rate of the loan. And the loan usually has a fixed time for repayment, 1 year, 2 years, 5 years, and that's called the term of the loan. The one thing that's interesting about the loan is that there is no ownership or decision-making power inherent in debt financing in general, as long as you keep paying them back. If you don't pay your interest payments, in certain cases, the person who's made the loan might be able to force you into bankruptcy. But in general, they don't control your strategy, your marketing decisions, your product development. They don't have a say in running your business. So what are the advantages of doing this particular type of financing? First of all, it's very simple, and the entrepreneur gets to keep the ownership and control of the company. The disadvantage is, you don't gain much from interacting with the loan officer. You can't ask them for advice on running your business. They're not experts in running a business. And a huge disadvantage, of course, is you need to keep generating cash. You need to keep paying back the loan every period, whatever that is. And maybe it's a monthly payment or quarterly payment. You need to keep paying back the loan, and it does eat up some cash. Okay, the third type of financing is called equity financing. And this is where the entrepreneur gives up an ownership stake in the company. So that means that the entrepreneur is receiving some cash from the investor and in return is selling a share of the company. And that means that the company is going to have a certain valuation. Now, the definition of valuation is basically the total expected value of all the future profits of the company brought back into the present dollar terms. So, for example, you might ask an investor to give you $100,000, and you're willing to give up 25% of your company to receive that $100,000. Well, that makes your company worth $400,000, more or less, post money. We call it post money because the $100,000 is actually included in the $400,000, making it for 1/4. In other words, 25% of the company. Now, that money that valuation is $400,000 would be brought forward in any future rounds, and depending on how things change in the market, that would be the basis of the valuation. That would be the pre-money valuation for the next round if nothing changed. Now, of course, you might find out that the market is growing more rapidly than you thought before, which would make your pre-money valuation grow in the interim. All of these details, this kind of pre-money valuation, how much you're expecting, how much of the company you're giving up, and how much the company is worth afterwards, are specified in what is called a term sheet. This basically gives the terms and conditions for the investment itself. So, why would you want to go through all of this to gain some investment in your company? Well, the first issue is that you can have a network and you can get advice from the people who make the investment. People often call this smart money because that means the money is coming in plus you could get the advice or the network from the investors. And another good reason for doing this is that this reduces the cash drain on the company. Since you don't need to pay the interest like you would in a loan, you can then be more flexible with your business operations. Of course, the biggest disadvantage is the one I think maybe entrepreneurs think about this a little too much, is that they have to share the ownership and control of the company with the investor. So that means the entrepreneur is no longer the sole owner, or the entrepreneurs, the founders are no longer the sole owners of the company, but rather they are now sharing ownership in whatever percentage they agreed upon with the investors. And some entrepreneurs are very nervous about giving up ownership and control. There might be some legal reasons too, legal protections for the minority shareholders in this particular case, which might also constrain the ability of the entrepreneur to do whatever he or she wants to do. The last type of financing that we want to talk about today is called convertible debt or convertible note. Now that is debt that can be converted into equity later on. So in the beginning stages, the investment is treated as any other loan, and the investor receives interest payments. However, at a certain point, which is, can be agreed upon in the term sheet, the investor has the right to take the value of the debt and convert it into equity. Now, when could they do this? This could be set up in the term sheet to be milestone-based, or it could be time-based. Of course, there needs to be an equity round for this to happen so that there is a valuation of the company. But it could be when the first equity round is closing. It could be in the second one. It could be other milestones when you've received a certain amount of sales, when you've received profitability, reached profitability. Or it could be a time-based thing like after 1 year or 3 years. If there is an equity round that creates a valuation of the company, then we can convert the amount that was invested in debt and convert it into a partial ownership of the company. Now, what's the conversion rate? This is a little bit trickier to explain, but basically to entice the investor to make this investment, you need to offer some sort of cap, a valuation cap, on the valuation of the company in the future. So, for example, if I were to lend you $100,000, you might say to me, well, in the future, if the company is worth more than $1 million, we will pretend for this particular exercise that it's worth exactly $1 million, so that you will end up with 10% of the company. If it's worth $10 million, you still get 10% of the company because your valuation is capped. Otherwise, the investor might think, well, I could put in $100,000 now, but if this company really takes off, which is what everyone wants, then I am going to be left with only 1% of this company, even though I took a big, big risk lending them this money in the early stages. So that's why these valuation caps are set up as a bonus or as an enticement to the investors. So why would you want to do this kind of financing? It's becoming more and more common. There's definitely a trend toward convertible debt. It can be quicker to negotiate than an equity investment, and it definitely delays the valuation discussion. Some entrepreneurs don't want to decide too early on the valuation of the company. So rather than going straight to an equity round, they might do a convertible debt, and they would then postpone the first valuation of the company. The disadvantages, as you can see just from this short discussion, there's some pricing risks on both sides. This is something that you need to have someone else with expertise look at. The caps can be complicated, and if there's no equity round, you're still paying that coupon, you're still paying the loan off, so you'd still owe money plus the principal. You'd still owe the principal to the original investor even if you never make an equity round. Now let's talk about the investors. Who are these investors that are going to be throwing money at your business? There's a wide range of investors, and starting from, as you can see here, a list I've created from friends and family all the way down to strategic partners. And so what I wanted to do here was simply walk through each one of these and talk about them briefly. What we'll do is in the next few segments, we'll go through some of the more important ones here and give a lot more details about it. But for now, just wanted to kind of give you the definitions of these different sources so that you're fully aware of the sources. So let's start with friends and family. That's pretty obvious. You're going to be asking your friends and your family to be investors in your business. They can give you gifts. They can be part owners in your business. That makes things complicated later on, but it is possible. Or they may lend you money. Crowdfunding is something that's relatively recent, but something that is fairly interesting for startup companies, because you can make a pitch to a very wide audience on an IT platform, information technology platform, an internet site, and you can pitch people who would either pre-buy your product before it's even done, or in beta testing, or they may actually make, depending on the platform, make an equity investment in your company. Banks, as we know, can lend money to companies. Foundations are often set up to fund certain causes, and they can be a very, very interesting source of donations early on in a startup's life. Startup competitions, business plan contests, etc. Usually these are competitive. You generally get some advice from the audience or a panel of judges or a jury, and you can win, prize money, which could help fund the initial stages of a company. Angel investor is a wealthy person who's often made money as an entrepreneur in the past and would like to fund early stage businesses. Often angels join together in big groups so that they can have a bigger impact on the company, in which case the angel group meets regularly and entrepreneurs make pitches in front of the angel groups, and the angel groups vote and decide whether they want to go in and make a bigger investment in the company. They would be getting equity in this particular case. A family office is something that is set up by a family business, and it would be an investment vehicle, like an institutional investor for that family. A venture capitalist is a specific kind of investor that makes investments in startup companies, usually later stages and for more money. We'll talk about that next. And they are definitely interested in an equity position in the company, and they would like to see an exit event happening because they raise money from other people who are trying to look for investments, and they take that money and they invest it in startup companies. And then when the company exits or has an exit event, then the venture capitalists take the money and pay back the original investors. And finally, a strategic partner is usually a large company that could be a potential customer or complementer, and that's a company that might be interested in acquiring a startup company. And finally, put on there just for reference, we say nobody. In other words, there's no investor. That's the bootstrapping mode. That means that you, as the entrepreneur, are making money from the operations of your business, and you're using that investment to continue to run your business. So you pull yourself up by your bootstraps, and call that bootstrapping. Great. So now that we've discussed the different kinds of investors, what we want to do is give a brief overview on what to expect in terms of the amount of money you might raise from each of these types of investors. So that's what we're going to do now, and then we'll come back and do all the details in the next two segments when we talk about seed financing next, and the segment after that we'll talk about expansion financing. So for this case, what we'll do is we're going to look at this slide, and we're going to just take a quick graph of the kinds of investors and how much money, roughly the range that you'd expect to raise from each of these types. So on this slide, what you see is on the left, we have a list of all the various types of investors. And at the bottom, we have an axis which refers to how much money you'd expect to receive roughly from each of these types of investors. Just to give some idea of the scale, what I've done is I've calibrated the scale on a log scale. And so we're going to go from 1,000 to 25 million, and that's those are in dollars, and you need to calibrate that to your own economy to how much money you can raise. I'll give you some ideas of some of the equivalents here. So let's just start with the left side, which is going to be, let's just say 1,000. Okay. And then over here, we can draw here, and then we'll draw 10 million here. Okay. So between 10 million is about 100K. So, which is approximately 2 times GDP per capita, just to calibrate a little bit. Okay, let's put here 1 million. 1 million, roughly here. And that's going to be 10,000. And then up here, we would say just roughly, let's just put one more in. So along this axis here, then we see the amount of money that one might expect to raise. And now we're going to go through and we're going to draw a line showing the rough range and the kind of a typical amount that one might expect from each of these sources. So the overall trend of this list is as you move down the list, the amount that you could expect to raise would go up, and therefore they would be used at some later stages, the higher amounts at the later stages, and the earlier amounts at the earlier stages, just as we've already discussed. The first one on the list is friends and family. Now that's where you ask your friends, family, and other people that you love to give you money and or to give you a very cheap loan. This is a relatively small amount of money that can be raised. And a typical amount that might be raised is on the order of $25,000. Crowdfunding is where you use an internet-oriented platform to reach a large number of anonymous people. And there, it's even less than friends and family. And on the order, 7,000 will be a typical amount. So for banks, you're taking a loan from a bank. Typical amount lent is 25,000 or so, and the range might be anywhere from the lowest amount, 1,000, to even up to 500,000. For foundations and public organizations, what you're doing is you're typically asking for grants, and these tend to be relatively small amounts, anywhere from, let's say, 5,000 to 200,000, and a typical amount would be on the order of 10,000. Startup competitions. This is a contest where you pitch your idea and you can win prizes. Prizes are usually on the order of $10,000, and they could range anywhere from 1,000 up to 50,000, somewhere in that neighborhood. For angels and angel groups, there's actually a distinction. We're going to draw a distinction here between an individual angel and a group of angels working together. So the earlier stage financing is going to be to raise money from an individual person, and that might be on the order of 50 to 500,000, with a typical amount maybe on the order of 200,000 or so. So for an angel group, that would be a group of angel investors who invest together, and so therefore the amounts would be higher, typically somewhere between 250,000 and 1.5 million. Typical amount might be $1 million or so. Family offices are a little bit different in that generally they are doing the investments for a single family, and they usually do not make direct investments into startup companies. They would rather make indirect investments by putting a larger chunk of money into a venture capital fund. But occasionally, through some contacts or through luck, you might be able to engage a family office directly, in which case it's going to be on the larger side of the scale. And this would be relatively large chunks of money, usually for a very capital-intensive business and for a later stage, so you're already in the expansion phase. It's hard to say how much money gets spent by family offices in individual company startup investments. There aren't a lot of statistics on it because it's a relatively private operation. But some estimates have it at, on the order of several million to 10 million in an investment. Venture capital. So here the venture capital company raises money in their own investors, and they turn around and invest that money in startup companies, usually in the later stages to provide expansion capital. So generally speaking, they're going to start in the couple $1 million range and go up to maybe, say 10 million in investment, with a typical amount invested, on the order of 2 to 5 million, somewhere in there. And then finally, we have strategic partners. Strategic partners are large companies that may want to make an equity investment in a startup company. And they do it for a variety of reasons, which we will discuss in segment 4.4. So here we're going to talk about, on the order of $1 million to 25 plus million, with a typical investment on the order of 10 million. So that gives an overview of the rough ranges. You can see there's very, very big ranges on these. And as you can see, more or less, as you move down the list, the amounts get higher and higher, and the engagement becomes higher, and the expected stage of investment also becomes bigger. So there'll be later stages. So these ones at the bottom here are really more of the later stage investments, and the ones at the top are really more of the early stage investments. And the angels and angel groups are kind of in the middle. Let's talk about sales or exit events for the founders. Usually, the founders are selling some part of their company, and the investors are having the exit event. In other words, the investor presumably gets all of their original investment back, plus a return on the risk capital that they have invested. So these kinds of events can happen in different ways. Some of the most common ways are trade sales, IPOs, and to some degree management buyouts. Trade sale, we just started talking about a strategic partnership, an investor from a strategic partner, and the big company could eventually acquire the startup company. And from the startup's point of view, that's called a trade sale. You sell the whole company to another company. Another option is the company can offer some percentage of their shares to the public. And this is the IPO, or initial public offering. Now, this is done to raise large amounts of money in the public capital market. There are a lot of legal implications. The founders often become the minority shareholders, and there is a legal framework for how to govern the company after the IPO is done. But it does have the advantage of raising a large amount of capital, so that in case there needs to be some major investments made, or some big marketing expenses or other sorts of capital expenditures, then that would be a natural way to go to raise the money. The third way is a management buyout, and this is less common in a small company, but it could be that the managers themselves, the managers, executives, founders, would turn around and buy the company back from the other investors. And you've probably heard of a leverage buyout, and in a leverage buyout is where the managers borrow money to make this transaction. This table represents a summary of the sources of venture financing, with an emphasis on the more important ones that we're going to see. And we're going to go into the details of these various sources in the next few segments.